In the world of finance and investments, opportunities to earn high yields are always in demand. Today, we turn our attention to a sector that offers just that: business development companies, or BDCs. Imagine a unique group of entities designed to provide financing to small and mid-sized companies, those that often slip through the cracks of traditional bank financing. These are the business development companies. They exist on a unique crossroad where they share similarities with both real estate investment trusts, known as REITs, and private equity firms. BDCs are not just about filling the financing void. They are also about reaping benefits from special tax privileges. As a BDC investor, you are stepping into a world where companies are not required to pay corporate income tax, as long as they distribute at least 90% of their taxable income as dividends to shareholders. But the real charm of BDCs comes into play in a rising interest rate environment. As interest rates rise, so do the yields of BDCs. This is a feature that sets them apart, a characteristic that makes them a sought-after option for income-focused investors. Now let's bring some names into the spotlight. Consider Ares Capital, the largest BDC with a diverse portfolio of investments, or BlackRock TCP Capital, that primarily invests in senior secured debt of middle-market companies. And let's not forget PennantPark Floating Rate Capital, with a focus on floating rate senior secured loans. These BDCs, and many others like them, are not just about the promise of high yields. They are about the opportunity to be part of an investment landscape that is as diverse and dynamic as the businesses they finance. With yields as high as 10.2%, BDCs such as Ares Capital, BlackRock TCP Capital, and PennantPark Floating Rate Capital are certainly worth considering. As with any investment, business development companies, or BDCs, come with their own set of risks and rewards. It's important to understand these before diving in. Let's start with the risks. BDCs are particularly sensitive to economic conditions. These companies provide financing to small and mid-sized businesses, which can be vulnerable during economic downturns. If these businesses struggle, it can negatively impact the BDCs that have invested in them. This sensitivity can lead to potential negative dividend adjustments. In other words, if the businesses that a BDC has invested in aren't doing well, the dividends that the BDC pays to its shareholders could decrease. Also, like any company, a BDC may not always operate efficiently. Some BDCs may have a history of weak operations, which could impact their performance and subsequently their dividends. Therefore, it's crucial to look at a BDC's track record before investing. Now let's talk about the rewards. One of the main attractions of investing in BDCs is the high dividend yields they offer. These high yields are a result of the special tax privileges BDCs enjoy, similar to real estate investment trusts. This means they distribute most of their income to shareholders, resulting in attractive income opportunities. Additionally, BDCs have the potential for capital growth. As these companies provide capital to small and medium businesses, they are often in a position to benefit from the success of these businesses. As these businesses grow and prosper, so too can the BDCs that have invested in them. To sum it up, investing in BDCs is a bit like a high-stakes poker game. The risks are substantial, but the potential rewards can be equally significant. Despite the risks, BDCs like Blue Owl Capital Corporation, BlackRock TCP Capital Corporation, and FS/KKR Capital Corporation offer attractive opportunities for investors seeking high yields. Let's delve deeper into one of the BDCs making headlines recently, BlackRock TCP Capital. This business development company has been turning heads in the financial world, and for good reason. For starters, BlackRock TCP Capital operates with a fee-friendly structure. This means that the company's costs are managed effectively, allowing it to retain more of its revenue, which ultimately translates to more value for investors. But the benefits don't stop there. The company boasts a diversified portfolio, mainly comprising senior secured debt. This diversification helps mitigate risk, ensuring the company has a robust foundation to weather economic fluctuations. BlackRock TCP Capital has also demonstrated a strong return on invested assets since it first began its operations in 2012. This track record of performance speaks volumes about the company's investment prowess and its ability to generate consistent returns. In the current high interest rate environment, BlackRock TCP Capital has managed to outperform many of its peers. The company's weighted average yield on debt is higher than most BDCs, which is a testament to its strategic investment decisions and robust financial management. Equally noteworthy is the company's strong liquidity position. This not only provides a safety net in times of financial uncertainty, but also gives the company the flexibility to capitalize on investment opportunities as they arise. Recently, BlackRock TCP Capital announced a merger with BlackRock Capital Investment Corp. This move is expected to further bolster the company's market position and potentially pave the way for future growth. Of course, like any investment, BlackRock TCP Capital comes with its share of risks. Macroeconomic uncertainty could impact the company's performance, and the integration process following the merger could present challenges. However, despite these risks, BlackRock TCP Capital stands out as a high-yielding income opportunity. Its strong dividend coverage, competitive fee structure, and low non-accrual rate make it an attractive option for those seeking to add a robust BDC to their investment portfolio. As we wrap up, it's clear that BDCs offer unique opportunities for investors seeking high yields. We've explored the intricacies of business development companies, their high dividend yields, and the risks involved. We focused on BlackRock TCP Capital, a well-diversified BDC with a strong return on invested assets. However, remember that these high yields come with their own risks and rewards. So it's crucial to do your own research before making any investment decisions. And don't forget to subscribe for more financial insights and analysis. Until next time, keep your investments growing and your risks low.